All right, AI for stock trading, huh? Let's dive into this paper you sent over.
Yeah, see what we can make of it.
Neat algorithm-based stock trading strategy with multiple technical indicators of resonance.
Catchy, right?
Sounds pretty intimidating, I have to admit. But hey, that's what we do here. Break it down.
That's right. See if there's anything we can learn from it.
So first things first, this neat algorithm, what is that all about? It sounds like, I don't know, something out of a sci-fi movie.
Well, it does stand for NeuroEvolution of Augmenting Topologies, so yeah, kind of sci-fi.
Yeah.
It's a type of evolutionary algorithm.
So meaning?
Basically, it mimics natural selection, you know,
Yeah.
to find the best solutions to a problem. But here's the cool part.
Okay.
It actually evolves the structure of the neural network itself.
So it's not just tweaking the numbers.
Nope. It's actually like rewiring its own brain as it learns.
Wow, okay. That's pretty wild. And why is that so important? I mean, what's the advantage there?
It's all about finding creative solutions, really. Think of it like this. You're trying to solve a simple puzzle. You might just need a few basic pieces. But as the puzzle gets more complex, you need more pieces and more ways to connect them.
Right. Makes sense.
NEAT allows the algorithm to kind of build those more complex connections.
So it can think outside the box, so to speak.
You got it. It's
Yeah.
finding solutions that humans might miss because we tend to think in more, I don't know, linear ways.
Okay, so we've got this algorithm that can, like, think outside the box. But how does this all connect to the stock market? Is this thing actually placing trades?
Exactly. That's exactly what it's doing. The researcher used this neat algorithm to develop a trading strategy
Okay.
based on technical analysis.
Technical analysis. So we're talking about things like, what, moving averages,
Yeah.
relative strength index?
Yep, all that stuff. MCD, you name it. Think of it like, I don't know, a pro trader's toolkit, but analyzed by AI.
So this thing's really making trades. Like, was it day trading or more of a long-term investor?
Yeah.
How did they even teach an algorithm to do technical analysis?
They fed it a mix of 7 different indicators.
7. Okay.
Trend, momentum, overbought, oversold indicators. To train it, they used 22 years of historical data from the S&P 500.
Wow. 22 years. That's a lot of data.
It's called backtesting, essentially running a simulation to see how the algorithm would have performed in the past.
You back-tested this on 22 years of S&P data. So
Yeah.
any surprises in how it performed? I mean, compared to, say, just buying an index fund.
Well, if it had magically beaten the market, we probably wouldn't be having this conversation.
Right.
It's not about getting rich quick.
So what is it about then?
What's interesting is that it achieved similar returns to just buying and holding the S&P 500,
But there's got to be a but.
but with lower risk and more stability.
Lower risk, more stability? That sounds like, I don't know, something investors dream about. How did it manage to pull that off? Did it just avoid making any trades during big downturns or something?
It wasn't quite that simple. The researcher had to experiment with different fitness functions to guide the algorithm toward that balance.
Fitness functions. Is the algorithm doing CrossFit now? Getting ripped to trade?
No, not quite. A fitness function is just a way to tell the algorithm what to aim for. It's like, you know, setting a goal, then giving it a reward for getting closer to that goal.
So it's like training a dog.
Yeah, kind of, like giving it a treat for doing the right thing. The first function they tried didn't work well because it basically incentivized a buy and hold strategy.
So like giving the dog a treat just for existing? No wonder it just sat there and held the stock. What about the second try?
The second one was too focused on making quick profits.
Okay.
Encouraged risky behavior, like a gambler going all in on every hand. Too volatile.
All right, so the first one was too passive. The second one was too reckless. Goldilocks and the 3 fitness functions. What was the magic formula? How'd they find the sweet spot?
The third fitness function added rewards for making, I guess, smart trades.
Okay.
And penalties for holding assets for too long. Think of it like a, I don't know, performance bonus for a fund manager, encouraging them to make profitable moves, but also keeping their risk in check.
It's like a checks and balances system for the indicators.
Yeah, something like that. And this finally led to a more balanced and ultimately more successful strategy.
So it sounds like it's learning, adapting, almost like it's got its own trading style developing.
That's a great way to put it.
But how do we know it wasn't just lucky during those 22 years? Can this thing really adapt to different market conditions? I mean, that's the million-dollar question, right?
It is.
Tell me more about the results. You said the returns were similar to buy and hold, but with lower risk. So what did that look like in the numbers? Did it show any preference for certain types of trades?
Well, the algorithm tended to favor long trades over short trades, Probably because the overall market trend during the testing period was upwards.
Makes sense.
It was basically, riding the wave, so to speak.
Okay.
And the standard deviation of the returns for the algorithm strategy was a full 20% lower than the buy and hold strategy.
Wow, 20% less volatility. That's huge.
So it achieved similar gains, but with much less volatility, less risk.
It's like it's learning to read the market's mood.
That's a good way to put it.
Makes you wonder if it could handle a bear market too. What about those returns, though? Were they really that close to a plain buy and hold strategy?
The average return was slightly lower than buy and hold, but it also had lower risk exposure, because it wasn't holding assets for as long. And importantly, it achieved a very similar win rate.
Okay.
You can actually see this visually in Figure 3 of the paper if you want to take a look.
All right, so it's not beating Warren Buffett or anything,
Mm.
but that lower risk is definitely tempting. But before we get ahead of ourselves, you mentioned earlier that the algorithm wasn't always efficient. What do you mean by that? Was it, I don't know, burning through too much electricity trying to make these decisions?
No, not quite. It's more about the complexity of the neural network itself. It ended up with a lot of nodes and connections that weren't actually contributing to the decision-making process.
So it's like a brain with, I don't know, some extra unnecessary neurons firing, like
Yeah.
a little bit cluttered.
Exactly. It needs a bit of decluttering, and that's one of the challenges the researcher highlighted. Finding ways to streamline the network structure and make it more computationally efficient.
So less clutter, more speed.
Exactly. Could make it even more powerful.
Makes sense. So where do we go from here? Is this something that, individual investors could actually use? I mean, we're not all coding wizards, right?
That's a great question, and one we'll explore more in the next part of our deep dive. But before we get there, let's talk about the broader implications of this research and what it tells us about the future of AI in finance.
Sounds good.
Buckle up.
I'm ready. All right, so we've got this neat algorithm. It can learn, it can adapt, it's making trades based on technical analysis, but it sounds like it's still, in the experimental phase. So what are some of the challenges in taking this from, I don't know, the research lab to the real world?
Well, one of the big ones is making it more efficient.
Okay.
We talked about the cluttered brain problem.
Yeah.
All those unnecessary connections in the neural network. Streamlining that would make it faster and, less computationally expensive.
Okay, so less clutter, more speed. But are we talking supercomputers here? Is this even something an individual investor could use, or is this just for, like, hedge funds with deep pockets?
Well, the technology is still evolving, but there are already platforms and tools that make AI more accessible to, I don't know, everyday investors. And even if you're not building your own, trading bot, just understanding the principles behind these algorithms can give you an edge.
So even if I'm not a coding whiz, there's still something to learn from this.
Absolutely. Think about what we've discussed. Using multiple indicators, looking for those resonant signals, understanding risk management. These are concepts any investor can apply, regardless of whether they're using AI or not.
Okay, but hold on. Isn't that what, every technical trader tries to do? What makes the neat approach different?
It's about taking those principles to the next level, really. The NEAT algorithm can analyze vast amounts of data and identify subtle patterns that, humans might miss. It's like having an army of analysts working for you 24/7.
Okay, I'm starting to see the appeal. Let's go back to those 22 years of historical data for a second. What exactly was the algorithm looking for in that data? I mean, was it just the raw prices or something more?
Remember, we're talking about technical analysis here. The researcher extracted specific features from the price data, those 7 technical indicators we mentioned earlier.
Right. That became the input for the NEAT algorithm. It's like giving the algorithm a set of lenses to view the market through.
So it's not just looking at the numbers, it's interpreting them, looking for those patterns and signals. But with so many technical indicators out there, how did they choose which ones to use?
They focused on indicators that could provide insights into trends, momentum, and potential overbought or oversold conditions. A well-rounded toolkit, so to speak.
Okay.
And the algorithm could then figure out which combinations of indicators worked best in different, market scenarios.
So, the algorithm is developing its own trading style based on what it's learned from the data.
You got it.
That's fascinating. But let's shift gears for a moment and talk about the bigger picture. Where do you see this technology heading in the next, I don't know, few years? Are we all going to have like AI robots managing our portfolios?
I don't think robots are going to replace human investors anytime soon.
Okay, good. But AI is going to play an increasingly important role in finance. We're already seeing it in areas like fraud detection, risk management, portfolio optimization.
Right.
And yes, algorithmic trading is becoming more sophisticated and accessible.
So it's not about replacing humans. It's about, like, augmenting our abilities,
Yeah.
giving us better tools and insights.
Exactly. Imagine having an AI assistant that could analyze market trends, identify potential risks, suggest trading ideas. It'd be like having a personalized financial advisor available 24/7.
That sounds pretty amazing. Sign me up. But let's be realistic here for a second. This technology is still relatively new. So what are some of the potential, I don't know, downsides or risks that we should be aware of?
One of the big ones is over-reliance. We need to remember that AI is a tool, and like any tool, it can be used improperly. We can't just blindly follow the recommendations of an algorithm without understanding, how it works and what its limitations are.
Right, right. We don't want to become slaves to the algorithms.
Exactly.
We still need to use our own judgment and critical thinking skills.
Absolutely. Another risk is data bias. The quality of the data used to train an AI algorithm is crucial. If the data is flawed or biased, the algorithm will, inherit those flaws and could make poor decisions.
Garbage in, garbage out, as they say.
Exactly. It's all about making sure the AI is learning from, I don't know, good, clean data.
But what about the ethical implications? I mean, as AI becomes more powerful, how do we ensure it's being used responsibly?
That's a crucial question and one that's being debated at, the highest levels. Transparency is key. We need to understand how these algorithms are making decisions and what factors they're taking into account. We also need to guard against unintended consequences.
Unintended consequences, like what, Skynet becoming self-aware and taking over the stock market.
Hopefully not that dramatic. But AI systems can sometimes behave in unexpected ways. It's important to, monitor them closely and make sure they're aligned with our goals and values.
So it's not just about the technology itself, it's about how we use it and, like, the ethical frameworks we put in place. Makes sense. But let's bring it back to the individual investor for a moment. You said that even if we're not building our own trading bots, we can still learn from this research. So how can we, level the playing field a bit and compete with the big institutions that have all these fancy algorithms?
It starts with education. There are, tons of resources available online and in libraries. Learn about different technical indicators, backtesting techniques, risk management strategy.
So do your homework, basically.
Exactly. And don't be afraid to experiment. There are free backtesting platforms where you can test different strategies and see how they would have performed in the past.
Okay.
It's a great way to learn and develop your skills.
That's a great tip. Anything else we should keep in mind?
Remember the concept of multi-indicator resonance?
Right.
Don't rely on just one indicator to make a decision. Look for confirmation from multiple sources before, entering or exiting a trade.
So it's like getting a second opinion before making a big financial decision.
Precisely. And always, always manage your risk. Don't bet the farm on any one trade. Diversify your portfolio. Use stop-loss orders to protect your capital.
Sound advice. So even if we're not using, fancy AI algorithms, we can still learn from the principles behind them and apply them to our own trading. But I have to ask, what about those folks who are, interested in actually using AI for trading? What are some practical steps they can take?
Well, for starters, they need to choose the right platform. There are a growing number of AI-powered trading platforms available, each with its own strengths and weaknesses. It's important to do your research and find one that aligns with your, investment goals and risk tolerance.
And so it's like choosing the right brokerage account, but with an AI twist.
Exactly. And once you've chosen a platform, you need to familiarize yourself with how it works. Most platforms offer, tutorials and demo accounts so you can practice before risking real money.
That's reassuring.
But even with the right platform, wouldn't you still need some, coding skills to set up your own trading strategies? That's a common misconception. Many AI trading platforms are designed to be user-friendly, even for those with, limited coding experience. They often use drag-and-drop interfaces or pre-built strategies that you can customize to fit your needs.
So it's like building a Lego set, but for trading strategies.
You could say that, but it's important to remember that even with user-friendly platforms, there's still a learning curve. You need to understand the basics of how AI works, how to interpret the data, and, how to manage your risk.
It sounds like a lot to learn, but also incredibly exciting. It's like opening up a whole new world of possibilities for investors. But before we get carried away, I want to bring us back to the paper we started with, and the NEAT algorithm specifically. What are your thoughts on the future of this particular approach?
The NEAT algorithm is a fascinating example of how AI can be used to create more, adaptable and robust trading strategies.
Adaptable and robust, two words every investor loves to hear.
Exactly. And I think we'll see more research in this area, exploring ways to improve its efficiency, scalability, and performance.
So it's not just a one-off experiment. It has, like, real potential for the future of AI trading.
Absolutely. And it's not just about, trading stocks. I think we'll see similar algorithms being used for other types of financial decisions, like portfolio management, risk assessment, even financial planning.
It's like AI is becoming the, ultimate financial advisor,
Yeah.
helping us make smarter decisions across the board. But let's not forget the human element.
Precisely. AI is a powerful tool, but it's still just a tool. It's up to us as humans to use it responsibly and ethically. We need to stay, informed, engaged, and critical, ensuring that AI serves our best interests and helps us create a more, sustainable and equitable financial system.
Well said. I think that's a perfect segue into the final part of our deep dive, where we'll explore the broader implications of AI for the financial industry and what it all means for investors like you and me. We've covered a lot of ground in this deep dive.
Yeah, we have.
From the nitty-gritty of this neat algorithm to, the broader trends of AI in finance. But there's one thing that keeps coming back to my mind.
What's that?
We've talked about how AI can help us, make smarter investment decisions.
Right.
But what about the impact of AI on the companies we're investing in?
Oh, that's a great point. Yeah, it's not just about using AI to pick stocks.
Right.
It's about understanding how AI is reshaping the entire business landscape. I mean, think about it.
So it's like adding another layer of analysis to our, investment decisions. Not only are we looking at, traditional financial metrics,
Right.
but we're also considering companies like AI IQ, so to speak.
Precisely. Companies that are effectively leveraging AI
Oh.
to create new products and services to optimize their operations, to gain a competitive edge. Those are the companies that are likely to thrive in the long run.
It's like AI is becoming a key differentiator, a factor that, separates the winners from the losers in the market.
Absolutely. And this requires us as investors,
Yeah.
to stay informed about AI advancements, to understand the trends in different industries, and to
Right.
analyze how companies are adapting and innovating.
It sounds like investing is becoming even more complex. I mean, we need to be experts not only in finance,
Yeah.
but also in technology.
It's a challenge, but it's also an opportunity, for those who are willing to embrace continuous learning, to adapt to this evolving landscape. There are tremendous opportunities to make, informed and profitable investment decisions.
So it's not just about picking the right stocks.
Right.
It's about understanding the forces that are shaping the market
Right.
and positioning ourselves to capitalize on those trends.
Absolutely. AI is one of those forces, and it's only going to become more powerful and pervasive in the years to come.
Well, this has been quite the eye-opening deep dive.
It has.
We've explored the potential of AI to revolutionize trading. But we've also acknowledged the importance of, human oversight, ethical considerations, and the need for continuous learning.
Yeah, AI is a tool. That's worth remembering. Just a tool.
So as we wrap up this episode, any final thoughts for our listeners?
I just want to encourage everyone to stay curious, to stay informed and to engage in thoughtful conversations about the future of AI in finance.
Because ultimately, the future is not something that happens to us, it's something we create.
Exactly. We've only scratched the surface of this topic today.
Yeah.
But hopefully we've, sparked your curiosity, given you some food for thought.
Definitely has for me. So to our listeners, where should they go from here?
Remember, the journey of discovery doesn't end here. We encourage you to continue exploring, researching and engaging with the ideas we've discussed.
Yeah, absolutely. I second that. And be sure to let us know what you think.
Yeah, share your thoughts, your insights, and your questions with us on social media using #TheDeepDive. Let's continue this conversation together.
Great. Well, until next time, keep diving deep into the world of knowledge. And remember,
Yeah.
the future of finance is in our hands. The